have some money and you want to invest. But which company should you invest in? And how do you know when to invest in a company? There are many things to consider, but one of the most important is the valuation. You only want to buy a company that is a good price for the value you are getting. How do you know if you're getting a good value? Consider the price per earnings, or the PE. To understand what price per earnings means, let's use an example. Your friend Ben has a coffee shop that he hopes to expand. To raise some money, he tells you that he will sell you part of his company. He explains his coffee shop makes $250,000 in earnings per year. He will sell you 10% of his company for $500,000. Is that a good deal? To make matters even more complicated, the next day your friend Maggie tells you she is selling shares of her company, a small local grocery store. She tells you her company earns $150,000 per year, and she will sell you 10% for $225,000. Which is the better deal? Which should you invest in? Putting aside whether you like Ben or Maggie better, let's consider the value of investing in their companies. To calculate the price per earnings for Ben's coffee shop, we divide the price, $500,000, by the earnings. In this case, we are getting 10% of the company and thus 10% of the $250,000 in earnings. 10% of $250,000 is $25,000. When we divide $500,000 by $25,000, we have a price per earnings, or PE, of 20. Now let's compare this to Maggie's offering by calculating her PE. She is also offering you 10%. 10% of her $150,000 in earnings means our ownership is equivalent to $15,000 of the company's earnings. $225,000, our price, divided by $15,000 equals 15. Generally speaking, we want to invest in companies that give us the most earnings for the lowest price. More earnings for lower prices means a lower overall PE. Many investors, such as Chuck Carnival, suggest a PE of 15 as a reasonable fair value for most companies. Knowing nothing more than the information we have discussed so far, which would you buy? Ben's coffee shop or Maggie's store? If you chose Maggie's store, you understand price per earnings and the basics of valuation. Now let's apply what we have learned from Maggie and Ben to companies like Apple, McDonald's, and Coca-Cola. There are many websites you can use to find the PE for the companies you are interested in investing in. Nearly all brokerage and investment service websites and apps will list the PE. I am showing you Yahoo Finance here because it is free and does not require an account. You can see here the PE is 18.2. If you wanted to calculate this yourself, just remember it is the price divided by the earnings. Currently, Apple's price is $229.24. The earnings, shown here as earnings per share, is 12.6. 229.24 divided by 12.6 equals 18.19365. Or, if we were to round that off, 18.2. So, is a PE of 18 a good value for Apple? Although a PE of 15 or below is a good recommendation for most companies, some companies tend to trade at a premium, some companies have higher growth prospects, and some industries tend to trade at higher or lower PEs. Although there are many factors to consider here, two things I like to look at is the company's PE compared to its own history and to its industry. Let's take a look at macrotrends.net. This website shows us the PE for Apple from 2007 until 2020. As you can see, the PE has gone down as low as 9. While the current PE is not the highest, it is higher than Apple's PE typically is. This would suggest its valuation is higher than usual. So how does Apple compare to the rest of its industry? We are looking at Fidelity's research tools. Although Macro Trends and Yahoo Finance do not require accounts, Fidelity does for this information. What we can see here is Apple's 5-year average for its PE is currently lower than its current PE. In other words, its valuation is higher than usual. We can see that it is higher than industry average of 16 and is currently at the 60th percentile. Now that you understand what the PE ratio is, can calculate it yourself, can interpret it, and know where to find it, you are ready to take the next step in your investing journey. Good luck! And if you found this information helpful or believe it will be helpful to others, please like, comment, and subscribe. Doing so will help the YouTube algorithm connect this video with people who may want to see it. Thank you so much.